that we are going into more uncertain environment. So the impact for the higher for longer interest rate, I think those are starting to filter through the economy. China recovery has yet to come about. And of course, the recent geopolitical tension have added to the volatility. But our regional fundamentals, we are confident because we still have low unemployment and robust consumption. So as a matter of fact, if you remember at the recent IMF briefing in Singapore just last week, the IMF indicated that despite a challenging environment, the region remains a bright spot. And in fact, APEC economies are on track to contribute 2/3 of the global growth this year. So we expect ASEAN to remain resilient. We also see more investment flows, especially in the new economy area like sustainability. We also see supply chain shifting into ASEAN. Hence, we are quietly confident, of our outlook and guidance.
And so what is your forecast on asset quality, given that we are likely to see higher rates for longer? I know you're confident about the unemployment levels and the income levels and the serviceability of loans. But even so, want to get a sense, because at a time like this, you have debt markets which are highly correlated world over. And if something happens in the US, let's say in the commercial real estate market, could the pressure be felt here in this part of the world? And so from that perspective, how you're looking at asset quality and the risk of delinquencies?
It's a good point that you raise. The market is obviously worried about the rising interest rate. At which point will it break the market? You highlighted a few hotspots, which is really the commercial real estate. So the US commercial real estate remains a hotspot, especially with the low occupancy rates that we have. The other hotspot will be China. There is worries about the quality and whether they can manage the property uncertainty in China. Whereas for the region, I think that we are less worried in the sense that there's still economic growth. I think we are still forecasting 4% GDP growth, average growth for the region itself. So I think the one that we need to keep very close eye is on US and Hong Kong, China. Hong Kong, China itself, on our portfolio, we are a bit more confident because a lot of this have very strong security, collateral, and strong sponsors. So while we are mindful, but we don't think that we do have systemic weakness in our portfolio. So we expect credit quality, asset quality to remain stable, and watch out for pockets that might hit us.
Okay, so if the credit quality does remain stable, and that's completely understandable considering the dynamics that might not be an exogenic shock that could risk that. But in terms of, I suppose, the flow, that the foreign direct investment coming into the ASEAN region, it has been requisitely strong. But if we continue to see a downturn in Europe, we continue to see a downturn in the US, the expectation is we could be seeing recessionary conditions there, and then not to mention what's happening in China. Is there a risk that through no fault of your own and any of the banks when it comes to Singapore or even the ASEAN region, that we will see a contraction in that foreign direct investment coming through in 2024 and 2025 and the impact that could have?
So I think you're right. Are we too bullish? Our view today is mild recession. And if the US rates continue to go up and if they continue to have problems with funding their economic growth, if they have higher NPLs flushing through the banking system, and if the geopolitical tension lasts a bit longer, will the mild recession scenario turn into a hard recession? So if you really look at it, what we have done was that we defended our balance sheet. A few things that